Good morning and welcome to In the Room with STANLIB. I am Arifa Isup, and today we are talking to Warren Buhai from STANLIB Asset Management. I would like to apologize for the technical difficulty that we experienced earlier. Thank you so much for your patience. Warren, welcome. Thank you so much for taking time away from managing clients' money to be with us today.
Thanks, Rifa. Nice to be here. I remember the conversation I had with Steve on the last Innate webinar I was on a few years ago. It was my first sojourn out of lockdown, so that was interesting. But nice to be here. Thanks for having me.
Thank you. Warren, you've been in the industry for more than 2 decades. Tell me how you got into this industry. Did it choose you or did you choose it?
Yeah, interesting story. So I have to go back to the earlier part of my career. So I joined Standard Bank, the old SCMB, in investment banking out of auditing articles in about 2000. And corporate finance had appealed to me at that time because I remember reading this book, Barbarians at the Gate. And it was an interesting book about a takeover of a company. And I'd watched some movies that looked exciting about finance. And I thought, what industry can I get into? And corporate finance and mergers and acquisitions. I heard all these terms. I didn't know what they meant, but it looked really exciting. And in I went. And it was exciting for a while. But what I realized over time is it was a lot less exciting than the movie show and that the book made out. And only about 10% of the time was it exciting deal making. And 90% of the time was a lot of laborious and monotonous implementation of the deal, which was a good realization to come to at some stage. And there was a vivid memory I have of a 3 a.m. meeting. Now that might sound like I'm making it up, but in investment banking, the culture is to work 24/7, 7 days a week, all the time, especially when you're on a deadline with a project, is you do all-nighters, you work all weekend. So anyway, we're sitting there. I can't remember what day of the week it was. They all just morphed into each other. And what happens in these deals is usually there's a corporate finance team of advisors on either side of the deal and a bunch of lawyers. And they make these huge documents of hundreds of pages that literally I don't think anyone's ever going to read outside of these two sets of people. And we're sitting there at 3 a.m. on page 500 of some agreement, version 17 of the agreement, and we're debating about where comma must go. Now, I'm not lying to you. This could go on for many minutes about debating that and come to a conclusion and everyone's happy. And a young lawyer sitting next to me turns to me and she says, "Isn't this what life's about?" And that's when the penny dropped for me. And I just turned and smiled at her because I didn't want to burst her bubble. I knew the career she's got ahead of her, but it certainly burst my corporate finance bubble. And that's when the penny dropped, as I say, and it said to me, "You need to find something else to do." And luckily, during my time in corporate finance, I was also involved in the formation of STANLIB, which was the merger between Liberty's asset manager and SCMB's asset manager. So I'd learned a bit about what asset managers do practically from a PM perspective and an analyst perspective. I'd been studying my CFA part-time while I was working at the bank. So I knew some people. Went to Bruce Hempel, who was CEO of STANLIB at the time, and said, "Bruce, I need to get out of this corporate finance." I said, "You know what it's like. You had been in investment banking for many years. I need to find something much more stimulating, something that's changing all the time." And from that perspective, asset management was appealing. I thought, I could get into a role. The market's never constant, it's always changing. I didn't really know what it entailed on a day-to-day basis, but I knew that it was going to be a lot more interesting than what I thought corporate finance was going to be for me at the time.
So better than being up at 3 a.m. debating where a comma goes.
Exactly. I hope that was the case. I'd rather be up at 3 a.m. debating where the yen's going to go. And I know that something's going to pan out differently in time. But the monotony was difficult in investment banking, which surprised me. I obviously didn't expect that going in.
Okay. So how do you think that the role of a portfolio manager has evolved in the last 2 decades?
Yeah, it's been quite a change. The change that I've seen, I would say the most is probably the technological change. Just how much I used to do manually when I started the industry. And when I started in the industry, I had some older guys in the team that used to tell me, I used to plot charts by hand. I thought that was a bit extreme, but I was glad that I had software that charted share prices for me. And I had been using Excel both through auditing and corporate finance, so that was good. But over time, as things have progressed, technology's obviously improved a lot. We've got coders in our team now that build apps for us, and it makes things much more efficient than they used to be. So I suppose from a practical perspective, that's helped a lot from efficiency and productivity. And then I think the role of the portfolio managers also evolved to be much broader. And what I mean by that, behavioral finance has become massive over the past 20 years. We've realized that portfolio management is not just about bottom-up micro analysis of companies. It's a much broader role of taking the client on a journey and making sure that the client understands the journey that you want to be on and kind of generate the returns they want. And you've got to manage them through that process. It's not just a case of you sign a mandate one day and I'll see the client every quarter for a report back. They actually want to know how you're thinking about it, how you're going to take them forward. And that role I saw morph. There used to be quite a big disconnect between us as PMs in my earlier days and where we were with clients. And that seems to have morphed in a much more congruent relationship going forward and trying to get them to the right outcome.
So you're saying there's a lot more engagement now with.
Yeah, I think much more engagement and the world, I guess, has also become much more financialized. And I think with that, again, it's a change. People have much more access to information. The market's much more in their face. They listen to programs on the radio every day on their way home from work. They watch things on social media. So I think people are much more aware of what's going on in the world. Gone are the days where they ask you simple questions. The questions are much more difficult these days, which is great. The engagement is much more interesting, both from their perspective and certainly from my perspective. And I think, and that's been a sea change in 2 decades. And can that change going forward? I'm sure it can, but there's no way the world's going to get less financialized than it is now. We've seen central banks much more involved in economies. Since the pandemic, we've seen governments be much more involved in the economies and realize things like the wealth effect, how important it is. I think it used to be on the margin important to governments. Now it's much more front and center. You can see it with the US election going on at the moment. People say it's vote buying, but that's the reality. What am I going to do with taxes? What am I going to do with childcare in the US? These are important issues for people. So the issues have moved from being just social issues, which they always are, to a lot of financial issues coming into even things like elections. This shows you how important financial markets have become to economies and people's lives.
So in the same grain, you've spoken about yourself and the shifts in portfolio management. But talk to me about multi-asset investing changes. How have you seen the shift of that from when you started versus now?
Yeah. In South Africa, it's been interesting. I always perceived, because I started as an equity analyst and portfolio manager, South Africa always seemed to be a bottom-up stock pickers industry. And I think the reason for that was because we obviously had exceptionally strong stock market for many decades. When you see these 100-year studies, South Africa is always, in local currency terms, is always near the top of the rankings as stock market performance. So it stands to reason that should have been the interest of the industry. And I think that's where most of the money went, both into equity funds and what we call high equity balance funds. And I think over time, there's been a realization both globally and here that there's a lot more to investing potentially. Over the last 2 decades, we saw the positives of a bond bull market and we saw negative correlations between bonds and equities. When equities did well, bonds did poorly, and vice versa. There was some protection when equities struggled that bonds did well. The old 60-40 portfolio that people talk about, it's really just saying, can you have different asset classes in a portfolio and have a better outcome than just purely sticking to equity? Do you have a smoother outcome? People say, I can't eat risk-adjusted returns. I hear that saying all the time. They say that in bull markets, obviously, because in a bull market, you just want to be in 100% in equities and enjoy the ride. The question becomes is what happens when it's not always a bull market? And then you want access to other asset classes. The nice thing now in our industry is, especially globally now that our offshore allowance has opened up to 45%, is the scope for other assets, not just equities and not just, plain fixed income that we always used to know as government bonds, is the scope for other asset classes, alternatives, has opened up hugely in the world. The ability to diversify portfolios to some extent, a lot more than we were able to historically, I think has also become a potential tool for us to use that we never had historically. And I think gone are the days where clients just wanted to talk about stocks. They wanted to talk about more holistically, multi-assets, to understand the concept. It's to give the client a smoother ride. And from our perspective, it's also the chance to give the client a better probability of achieving their long-term goals. Don't just rely on an equity bull market. Hope that an equity bull market comes around every few years and bails you out from poor performance. We don't think that should be the case. You should have a broader tool set, and multi-asset, we think, gives you that to be able to produce better, smoother, and better longer-term returns, better quality of longer-term returns, not this boom and bust scenario that you see often with equities over long periods.
So, Warren, I heard you speak a little bit about alternatives. I'm going to come back to that later.
Sure.
But I want to know from you, what are your core guiding principles in managing money? And I'll tell you where I'm going with this. At some point, STANLIB had more than one multi-asset franchises. So how did your personal values contradict or go against what STANLIB was trying to do versus what you were personally trying to do?
Yeah, it's an interesting question that has a long answer. If that's okay. Some of the history in STANLIB is exactly that. We had different multi-asset franchises that tended to be style biased. So one was biased towards growth investing, one was biased towards value type investing. And what we were thinking with that is we knew clients wanted different approaches to investing. So I think from a business perspective, we thought we can gather assets in both pools, where some clients only want value-based investing, some only want exposure to growth investing, and we thought that was the best way to go. The retirement of Herman van Velze last year from our team, who had been with the team for many decades, gave us the opportunity to take a step back and say, what is the best outcome for clients here? Is it to be skewed to a style bias and therefore give them that outcome? Or is it to think more holistically about multi-asset investing and give them the best case outcome we can give them looking forward? And we thought that was the better approach. More style agnostic, don't be skewed to one style too aggressively. And we think in a multi-strategy approach where you can have growth strategies, you can have value strategies, but holistically you can get a better, as I say, risk-adjusted outcome for clients over longer periods, we thought is the better route to go than just sticking to one style. And what we found, has been the problem with some of our franchises historically at STANLIB, especially in the multi-asset space, is exactly that, being too skewed to one style. When it's in vogue, we shoot in the lights out and top quartile for many periods. And then when that style goes out of vogue, is you fall down the rankings. And people are saying, I just want consistency of performance. I'm happy for you to be in the first or second quartile, but what I don't want is you either near the top of the first quartile or near the bottom of the third quartile or even in the fourth quartile at times. This volatility, my clients can't handle it. They want kind of more consistency. They want that consistency of approach. And we agreed with that. We thought this too extreme style bias was going to be to a detriment of our clients. And we think in the long run, a detriment to our business as well. And hence why we merged them and move forward with hopefully one multi-asset franchise now going forward.
So you spoke about merging your styles and things like that. I want to talk a little bit about volatility. How do you manage the volatility in multi-asset investing, seeing as there's multiple asset classes within there?
Yeah, there always is different volatility in different asset classes. And how we try and do it, we had the slogan at STANLIB, which I thought was great historically, the art and science of investing. It sounded like nice advertising, but in reality, I think it's true. We do it. A lot of the science behind it is just the back testing. You look at what asset classes do historically, what happens when vol rises, what happens when vol falls, what happens to the correlation to asset classes. Do they change as volatility moves up or down in different asset classes? And the answer is yes, it does. And you can back test these things and see what happens when that correlation changes and adjust your portfolio accordingly. The problem we've got nowadays is because markets are so fast moving, because things like geopolitics and liquidity become much bigger parts of markets, passive investing, as an example, becomes a much bigger part of markets versus active investing. These correlations change over time. The behavior of volatility changes over time. And where historically, when we said low volatility, for example, in equities would be a danger sign, we've seen extremely low volatility, for example, in the last few years since COVID. Through the pandemic, you had a spike in volatility. It came down quite quickly as the fiscal stimulus came out. And then we had a period of extremely low volatility for a long time. Historically would have been a big warning sign, be careful and reduce your risk. But what actually happened is volatility was low because of the change in the structure of the market. You've seen a huge amount of volatility trading by hedge funds around the world. You've seen a huge amount of retail investors, bizarrely, getting into short-term options trading. You've heard this term 0 day to expiry options, which is quite crazy. It's actually options that don't, when you buy them, they expire on that day. But there's been a huge increase in trading of those, both by professional investors and even retail investors, which has reduced the volatility. So the signal may not be the same as you've got historically. So it's important to know how the market's changing, and it's changing dramatically, especially since the pandemic, because of all the government involvement and central bank involvement, and the nature of the market is changing. I don't think we knew what we did when we locked people down, gave them stimulus checks. All of a sudden, they all became day traders. And not only did they become day traders in things like GameStop, is they became day traders in derivatives and options, which is quite fascinating, but it's potentially changed the structure of those markets now going forward, completely different to what they've been historically. So the message to me, which I have learned in my career, be careful of back testing for this exact reason. When quant guys come to us and they've got a great back test, this is the silver bullet for investing. Just do these 5 things and you'll always produce positive alpha. We're very wary of that. Not because the back test is a lie, the back test is probably perfect, is that the market changes going forward. And once people, they understand how the history works, and then the market figures that out and moves on to something else. They kind of take that alpha generation opportunity out, and you have to kind of adapt with the market as it moves forward.
I'd like to remind the audience to please place your questions in the Q&A for Warren later on. We will get to them as soon as possible. Thank you for that, Warren. So with volatility comes risk. Okay. How do you manage risk over an investment cycle? Balancing the different asset classes, because now you've got various asset classes within your portfolio, and you've got to ensure, and there's different risks associated with different asset classes. How do you manage that over an investment cycle?
Yeah. So I would say it's a similar answer, but it's again the art and science. The science is you look historically how asset classes behave, so what those correlations are over different cycles, and importantly, in what kind of cycle you are. So you see different behavior and different correlations potentially in a rising interest rate environment. Now, we've got to the end of that cycle. We've started to cut rates in most parts of the world. And potentially in a rate cutting cycle, the correlations start changing and we adapt our portfolios accordingly. The tricky part, again, is another overlay is what's happening while those interest rates are coming down. So as you'll know, coming out of the 2001 recession and the GFC, the central banks were cutting rates aggressively, but it was too late and markets were coming down a lot. Correlations went negative. In other words, equities came down, but bonds did very well. Now we're potentially in a soft landing world. And in a soft landing world, potentially those correlations can be quite different. As I say, if we're bringing down interest rates potentially for the wrong reasons, and that's another debate to have, but if we're doing it and there is indeed a soft landing, what it might spark is more inflation. And if we go into a period now when inflation is more sticky and higher than it's been for the past 20 years, you might find those correlations flip again to positive, like we saw in the 70s in that high inflation period. And again, we've got to, adjust the portfolio accordingly. We can't assume that's what's happened for the last 20 years is going to assume, going forward for the next 10 years. And that's the thing we're watching closely. Not an easy thing to answer at the moment because we're not exactly sure what scenario we're going into, but that's why we do scenario analysis. We can see, in a bullish scenario, what things will look like from both the correlation and a portfolio construction perspective. And if the scenario doesn't work out as bullishly as that, is the more mediocre scenario or a negative scenario, how much will our portfolio change? And what's nice about doing the scenario analysis, it gives us a sense of the ranges we've got for our portfolio. How much would we move equity relative to bonds, relative to commodities, relative to the credit exposure in our portfolio? And it gives us a nice guideline that as we see things evolving over time and in which direction, which scenario they fit into that we've mapped out, we can start moving the portfolio in that direction. So we don't second guess ourselves.
Okay. And in terms of global portfolios, how do you balance your global portfolio selection to complement your local or asset class? No, well, your stocks.
The stocks, yeah. So firstly, we've got a great offshore partner in JP Morgan that we set up the partnership a few years ago. And they've obviously got a massive global team. We realize we've done some of our own offshore investing from here. The advent of AI tools and big data allows you certainly to do a lot more global investing than we think you've been able to do historically because you have now access to so much data real time. Again, when I started in the industry, it was much harder to get access to this data. And we've got that now. Having an offshore partner that's got offices around the world, we deal very closely with their multi-asset team in London, very experienced team, a lot of strategy people, a lot of asset class specialists, and that helps a lot with our kind of idea generation. So we got to obviously do a lot of our own research. We speaking to JP Morgan every week or second week at the latest and bouncing ideas off them. We're looking where the themes are going. There's always themes in the market. Looking, are they priced correctly? Is there mispricing? Is that an opportunity? How best to play some of these themes is also an important one. It's not just, coming up with an idea and letting it complement or diversify some of the local holdings we got. It's how do you implement that? So a great example that I can think off the top of my head was in the last couple of years, JP Morgan were talking to us about the China alpha opportunity. And we said, well, we're not sure about the Chinese economy. We were a bit worried about what it was going through post-COVID. And they said to us, no, so are we. So instead of taking a beta bet, in other words, going into Chinese equity, we also worried that it won't do so well against global equity. But what they found with their analysts on the ground in China, a lot of under-researched sectors there. And what they found is consistently for a few years, they've been able to generate consistent alpha within that market. So can you kind of get access to that alpha opportunity within the Chinese equity market, but kind of hedge out the beta risk in case Chinese equity overall doesn't do well, but they can generate 2 to 3% alpha consistently just within Chinese equities. And those kind of pockets of ideas that are quite different to the South African market and global markets potentially are nice kind of things that you can add on. As I say, we think the multi-strategy approach of not just thinking about equities as a holistic beta is that there's a lot of different alpha opportunities in each of these asset classes. Fixed income's another one. We've only ever thought about it, I think, in South Africa as government bonds. Yes. Whereas when you look globally, the credit market is huge and different pockets of the credit market, high yield, investment grade, and even within those high yield and investment grades, there's different pockets, both regionally, again, thematic factor, and you can pinpoint exactly where you think the alpha opportunity is and mold it into the portfolio, again, to get hopefully a better outcome for the clients.
So, Warren, you spoke about alternatives earlier on. What alternatives, or are you allowed to hold alternatives in your portfolio? And how do you decide which ones to use?
Yeah, it's a good question in terms of, as you say, there's been an explosion of alternatives globally. The problem that we've had with alternatives, and we had kind of a bad experience in some of our life portfolios that we've run, where Liberty had put some of these alternatives into the portfolio, for example, African private equity. And private equity was the big theme, and they thought there was a lot of opportunities in the African space in both real estate and private equity. And what we found with these opportunities is while the long-term opportunity might be great, is that you have to be well aware of the illiquidity. And if you have cash flows in your portfolios, what often happens is those illiquid assets are the ones that you can't reweight in a portfolio. And therefore, over time, they can increase in weight. We were running some books that were closed. They were retirement books, so they were in runoff. And as that runoff of cash flows was going, so the alternatives were getting bigger and bigger. And it taught us a lesson that you've got to be very careful with your liquid assets in making sure you know why they're in your portfolio, what purpose are they serving in there, and are they improving the kind of risk-adjusted return in the long run. We still dubious about that. We think the craze and the rush of money into alternatives has been because they're not priced correctly. And what I mean by that, because there's not a listed daily market, is they don't mark them to market properly. Okay. So when you look at the returns of some of these alternatives, it looks like they're extremely low volatility. That's because they're not priced correctly. And unfortunately, that pricing only, that risk only comes to bear in a liquidity crisis. So when bull markets are on and liquidity is fine, like we've been in for the last couple of years, there's no problem with alternatives because they're not repriced. They only ever go up. Credit companies can kick the can down the road until interest rates come down further. They've got different ways of not marking them to market. But if ever there's a liquidity crisis again, and I have no doubt in my career there will be one day, I can't predict when it's going to be, but a lot of the things will come out potentially about alternative assets. I'm not saying certainly they're all bad. They do form a part of some portfolios, but at least from our franchise perspective, we think in the nature of the market that we're in now, that's become much more financialized, much more short-term thinking, a lot of involvement from both governments and central banks. We think it's important to be both flexible and keep liquid portfolios. And that's why we've been put off some of those alternatives. The one space I'd say where we do use them is derivatives. And derivatives for us are a much more useful tool in efficient portfolio management. So what I mean by that is things like futures, you can use, they're extremely liquid, they're easy to get in and out of, they trade outside of normal market hours like stock markets. Therefore, they're useful. And we also can use derivatives for currency hedging. And given that our offshore allowance has now gone up to 45%, we think structurally you have to think about your offshore allocation and the currency exposure quite differently. So just one example I'll give you, we find that offshore fixed income assets, most of their volatility is driven by the currency, how the rand moves. It's not from the underlying asset class. The underlying asset class is good if you can manage the currency. So instead of taking, say, 35 to 40% of your money offshore in a portfolio, if you think the rand's weak, instead of just bringing the money back and waiting for the rand to strengthen, keep the money there. The opportunity set offshore is so much bigger, as everyone talks about, but rather hedge the currency, hedging from a position of, is it going to strengthen? People always hear the word hedge and they think we're hedging the rand falling out of bed. No, that's why you take your money offshore. But what if the rand were to blow out to 25 and you were worried about it coming back to 20? You would want to be able to hedge that strength, and derivatives we think are a great and liquid option to be able to do that.
So how does that take away from the performance in terms of costs?
Yeah. So there is always a cost to derivatives, but that's the way up. If we thought the rand could strengthen 10 to 15% over a short period, if it's only going to cost us 1% of a portfolio to hedge a large exposure of that 40% that we have offshore, it's worth paying the price, because on a net basis, you're going to save 9% for a client if the rand were to strengthen. And if that was a high probability in our scenarios, that's when we would put on that sort of trade. So it's just balancing that way up between the cost and what's the benefit going to be to the portfolio.
So you're comfortable doing that as long as the costs or the performance outweighs the cost.
Exactly. The potential upside is going to outweigh the cost. And certainly over whole cycles, as I say, structurally, we think it's important. We've got guys in the team who've traded derivatives, like currency derivatives, for many years now, for more than 2 decades. And it's important to have that experience because, as you know, currency markets, especially the rand, are one of the most volatile asset classes that you can get.
But one of the best performing asset classes this year.
Correct. Exactly right. And these performance cycles come and go. And this is the point about multi-asset investing and why it's important to have that long-term approach is you can't pick that. If I had sat here a year ago and said to you, Arifa, property in South Africa is going to do over 50% over 12 months, which is what it's done now. You might have called for the white coats for me and put me away. And that's the exact point. We can't time these, but to some extent we thought property is undervalued, have a position in it. Where can it go? Maybe we thought in our scenarios it would do 10 to 15%, it then does 50%. You don't know where and exactly what time. And that's my point about the fast moving markets. You don't know what central banks are going to do. You certainly don't know what the economy is going to do. That's been proven to us time and again, especially post the pandemic. Have these exposures on, balance that way up between things like costing of putting a position on versus the potential upside. And importantly, look for the other thing I like about scenario analysis, and sorry to keep going on about it, but what it does highlight is where the asymmetric skews are. So what I mean by that is we can have bullish, bearish, and somewhere in between scenarios. But if it comes out with all the work we do and the forecasting we try and do of asset class returns, that a portfolio, say an asset class, is skewed massively to the downside. So we can see 10 to 15% upside, but on the negative scenarios, it could go down 40%. Clearly, that's a signal that don't put on a huge amount of risk in that asset class, because while the upside is there, there's a lot more downside potentially in the negative scenarios, which you don't know when they're going to strike. What's going to be the trigger for that? And likewise, the same on the upside. It looked like the likes of property and some other asset classes never had a huge amount of downside because they had corrected much more than everything in the pandemic. But they had, if things in a small way came right in the country and in the companies, they had a huge amount of upside. I'm not quite sure. We thought they had 50% upside, but maybe 20% or more upside. And over the last year, that's something that's panned out.
Were you positioned to take advantage of that?
Never enough, unfortunately. So we had closed our underweights. We had aggressive underweights in property, and we started to close them as it became clear that the asymmetric skew was more to the upside than the downside. But I would certainly be lying if I said we had big overweight positions. We just never saw. What we struggled with, especially on something like property in the local market, was the catalyst to change for that upside. Now, the catalyst came through the election and the announcement of the GNU that we saw a few months ago. And through that, going into the election, we started to become more positive on the upside because, again, we thought the downside scenarios, markets had corrected quite a lot in South Africa. Valuations were cheap. We started to put on more positions going into it. And post the positive outcome of the election, we started to put in a lot more positions focused on SA Inc., including property. And that's worked out well over the past couple of months.
Oren, I'm going to cross over to the audience for some questions. I have a few. Let's start with this one. In the changing investor environment you sketched, what is the relevance of strategic allocation, including systematic modeling, that most active managers will refer to as driving the long-term returns?
Yeah, I think it's, we locally now, we've also shifted quite a bit in our local equity. Most of our exposure is through our systematic solutions team. And how these guys manage money, it's a multi-factor approach, but importantly, they use quality, value, and growth. So what Rademeier, the head of that franchise, Rademeier van Mark and his team, what they say is they're looking for high quality companies that preferably grow better than the average in the market, and importantly, not overvalued. So when you mix all the factors together, as I say, what we would have done historically, just look for the high growth companies regardless of valuation, or just look at the cheap companies regardless of growth and quality. And now he's looking to blend all of them, which we find quite interesting. Him and his team have got a very long track record in producing consistent alpha through a cycle, and we think that's very useful to use. So to the question on strategic asset allocation, we think it's a similar idea. The tricky part's going to be how those correlations change going forward. So we do a lot of optimization modeling. People will mention this. All optimization is a fancy word for saying, how do I put multi-assets together and try get it on the best, what we call efficient frontier, that balance between risk and return. The problem you've got in optimization is you're making calls about what your future returns are going to be on each asset class. You're making a call on what the risk is going to be for each asset class. Is it going to be the same as historically or different? And the most important one is how the correlations are going to be. Are they going to be like the last 1 year, 3 years, 5 years, 20 years, or are they going to change going forward? And that's why I say the use of an active manager, especially in multi-asset investing and in tactical asset allocation, the benefit of the manager is going to be in guiding the path going forward of how those asset class correlations change. So strategic asset allocation is going to be critical always, but the trick's going to be in how you adjust your asset class ranges as those correlations progress. And as I say, we've got very different outcomes looking forward in if the correlations are positive or negative, because clearly it's going to be a different portfolio and what it looks like. And it's a very difficult thing to answer today. People ask us this all the time. What is the world going to look like in future? This is why we look at strategic asset allocation every 6 months, because these things do change and the environment changes. Central banks' view of the world changes. I'll give you an example. The current cycle we're in, a lot of people were shocked that the central bank cut 50 basis points last week. I'm not so sure we were shocked, but the surprise is that they're cutting aggressively when inflation's far above target. You remember a few years ago, the likes of Jerome Powell said, I will not be cutting interest rates until we're below target. Here we are today, inflation's 2.5%, happy to cut 50 basis points because they believe they're quite tight. Are they tight? GDP came out yesterday at 3% for the second quarter in the US. It was the third iteration of GDP, and they keep upgrading it. It came out a bit lower a few months ago, and growth looks good. Inflation's coming down, but is still far above the target, and they're happy to start cutting interest rates. So these things evolve over time. We think we're calling it the new regime scenario, where central banks are accepting high inflation. Growth's good. They're worried about unemployment. Unemployment's 4% in the US. People never thought it would ever get that low. When I started my career, they always thought 5% was the floor for unemployment. Now they're considering it moving from 3.4 to 4.2% as a disaster. So these things evolve and change dramatically. And that's the thing that we're cautious of giving too hard an answer for how strategic asset allocation will look looking forward, because we do think it will evolve over time. And that's the journey, as I said earlier, you have to go on with your client. Take them on that journey as things evolve and change, and as the correlations change over time.
And that inconsistency in messaging is probably very difficult to manage, because once they've made a decision that you're almost thinking they're going to do, and they don't follow through on that, they change it radically.
Yeah, and that's why we say again, flexibility in a portfolio, and therefore you've got to keep a liquid portfolio for that reason. If you've got a whole bunch of illiquid assets, alternative or not, they can benefit you in the long run. And again, it goes to time horizon and the client objective. And this is my point about one of the earliest lessons I learned in my career, and learned the hard way, unfortunately, is only when you've got bad performance does the mismatch with the client's expectation and the mandate come out. So you can hold up the mandate and say, Mr. Client, this is exactly what you agreed to. And the client says, that's not what I meant. And they only say that because they didn't understand what was in the mandate. So the best example currently is an inflation plus target mandate. So we get a mandate from a client that says, I want to generate over the full cycle inflation plus 5%. We say, okay, great. When we sign the mandate, do you understand this means that if we as a team believe we can get inflation plus 5, with mostly being in fixed income assets and cash, so low volatility portfolio, and in our mind, a lower risk portfolio than taking equity risk, but we think we can comfortably get the objective of CPI plus 5. Client says, I'm on side, signs the agreement. Time goes on, and over the next 5 years, there's a massive equity bull market. And while we're easily getting CPI plus 5 just in fixed income, the average portfolio out there is getting CPI plus 10. and the client says, well, it's not what I meant. Obviously, if there's an equity pool market, I want to participate. And that disconnect has come often. And that's the difficulty with making sure you're on sides with what the client wants, and therefore implementing. You don't get that kind of inconsistency with making these calls, but be flexible, because the client can also change. So, okay, I know what mandate I signed 5 years ago, but I see the world changing. I hear what you guys are talking about. Let's change this mandate. I don't think the mandate we had 5 years ago is applicable into the world you see going forward. And we have those conversations all the time nowadays.
So Warren, we were chatting before this, and you were telling me about a data analysis course that you're thinking about pursuing. But technology has taken over the world. There's AI, there's data analysis, there's ChatGPT, call it whatever. How has technology reshaped the way you do portfolio management? What tools do you think is indispensable in managing a portfolio these days?
So I'll give you 2 examples now of what we're using currently, but just to paint a picture for my own career, as I said earlier, technology's been a huge beneficiary for productivity. So we've got guys in our team with a lot of coding experience. I try to do a Python course. I can tell you, for those who haven't coded like me, it was like trying to learn Mandarin in 6 weeks. I wouldn't say don't do it. I'd say do it for the experience of learning how hard coding is. It was a huge eye-opener and I have new respect for people who can program. And yes, I've signed up myself for another course next year, maybe for my sins. This one looks a lot more practical through the CFA Institute, so hopefully that is the case. But what I found, the guys who can program in our team, as opposed to me using Excel, and over the years, what happens is the Excel files, as you all know, get bigger and bigger, and they tend to crash more often. It's funny, as wonderful as Microsoft is as a company, we still have instability in Excel. It's quite amazing. But what our programmers can do is convert those Excel massive workbooks into apps online. They go into the cloud now, can access them from anywhere in the world, wherever you're on holiday or whatever. It's not always a good thing, but you have access to these tools and you have access to real time. As long as you can pipe the real time data in from Bloomberg or Reuters, you have these tools that are much more efficient than working in Excel. So I'd say it saved us a huge amount of time. The other thing we do every week as a team is we pipe our views through SurveyMonkey. We do them individually. We don't like to influence each other. We ask the team every week, what are your views? What are the views on the lenses we use to look at the market? What are your views on asset classes? What are your views on the scenarios, how they've changed? And then every Friday, which I'll go to after this, is we have what we call a temperature check. What has changed in your views over the last week? Because everyone's reading different things, everyone's doing different work. Importantly, why has your view changed if it's changed? And is that telling us anything? Is there any signal in that? And the nice things about the apps the guys built is we can see this over time. We see how individual team members' views change. Are they being pulled by the market? Important to be aware of that bias. We also quite clearly can see the perma bears and the perma bulls in the team. So when they're speaking, you're aware of their bias, which is important, and we've got data to prove it. And you see how these things change over time. The other 2 examples I'll give you is we've been using Copilot now, as I'm sure many have been trialing over the last few months. Amazing thing about Copilot in meetings. So we've been recording our meetings for a long time now because we're building our own GPT model. And we're building our own model in piping all our meetings into that model, both the transcripts and the videos. We're piping in all our own research into that model, both the external research that we can subscribe to and internal research. And we're hoping that in the not too distant future, we're going to use that GPT model to help us in our investment decision making, because we're kind of curating what goes into the model that we think is useful to have, as opposed to just using the general ones that are public use that have way too much information in our minds. So where Copilot is very good now is it listens to our meetings, and I'm amazed by this. Within a few seconds of the meeting ending, this is whether the meeting in a morning meeting that we do every day is half an hour, or one that we do on a Friday is usually 2 hours. Within seconds of that meeting, you get an immediate 10-bullet summary of what the major points discussed and agreed, where the differences were, and an action plan. Warren, you should look at this. David, you should look at this. Muntu, you should look at that. It's just amazing about. And then we look at that as a team and say, geez, this is actually very good. We've got our own research list of what we want to look at. But here it's taking on what we're discussing, and it's thinking about the last few meetings and saying, you guys have been grappling with this issue, focus on that, move it up the research priority list. So that was a great example. The other one that I'm using personally is something called Chat PDF. I don't know if you heard about it. We all get a lot of PDFs. All you do is you drop the PDF. It's on a free website, chatpdf.com. And again, I've put in research documents of 200 pages. And within 5 seconds, again, I ask the question, give me a summary of this document instantaneously. 5, 10 bullet, whatever you ask it for, summary of the document, show me the evidence for that. Points out the chart, it can even read the charts. Here's where it is. So I'm thinking, I try to test it. I read a 50-page research report, which took me 2 hours, put it into there, and the same conclusions I would have taken 3 hours to come up with, reading and coming up with the conclusions, this was literally doing in 10 seconds. So this productivity benefit is an absolute game changer for all of us that love reading research, but there's way too much of it. If I had to read all the research that we get, I could read 24 hours a day and I wouldn't get to 10% of it. So tools like this are going to be indispensable in my mind. They're indispensable today, and they're just going to get better, as you can imagine, going forward.
I should have used it more for my research because I spent hours reading those journal articles that made me fall off to sleep more than anything else.
Exactly.
So I respect.
Please use them going forward.
But you've got a whole lot of these models and you're testing, you're using the data analysis, you're using the technology. Has there ever been a time when your gut instinct was something that prevailed over what the data was telling you?
Yeah, I'd say 2 recent examples. The one was a bit longer ago when I was an analyst, and I always loved going on field trips to companies. I used to do it in auditing, when you audited an industrial company and they would take you around the factory. The one I remember strongly was Seaton, the leather manufacturer for BMW seats. And I just saw how the process went. And the nice thing about those field trips is you learn a lot about the business and you see where the risks are. In auditing, they teach you, when you're going through these field trips, don't just look at it from an interest perspective. Obviously, look for where the risk could be in the process, where fraud can happen, where things can go wrong. And I remember vividly this trip I went on as a mining analyst to Angola with Transhex. I had been to copper mines in the DRC underground, which was fascinating. Diamond mines, it was just an open plain as far as your eye could see in the middle of nowhere in Angola where they looked for diamonds. And, my questions to the guys, to the management team were around, how do you know if a guy finds a diamond? It wasn't all manual, but even if he finds it through the mechanics of the process, how do you know he finds a large diamond? How do you know he's not going to put it in his pocket and run away? Because I'm just looking as far as I can see. There's no security anywhere here. And the guys were, no. We've got cameras everywhere. We've got monitors. We've got fences. You can't see them. They're further out, but guys can't get away. And the data they showed us was brilliant. The company looked brilliant. Usually when you go on these field trips, they obviously make everything look so good, which was another red flag to me. But the data was wonderful. And guys in the office, when I brought back and showed them the model, people just wanted to throw money at this. It looked like a wonderful opportunity. It was mispriced based on the data the company was giving us, public information, but it looked mispriced. It looked like a great opportunity. And my gut and some of the other people that had been on the trip with me, the gut was just like something doesn't look right. When you're going into these places, very hard jurisdictions to go into, we spoke to government officials. It was clear that there were potentially some dodgy things going on at high levels in some of these countries, and it just didn't feel right. And that was one time I would say where the gut feel was actually more important than the data. It's not always the case, but certainly that was one example that sticks in my mind. The other one more recently was through COVID. I remember, again, vividly sitting in Heathrow Airport. Marius Oberholz, our franchise head, and I had been to meet JP Morgan for the first time. And it just happened to be just before COVID, February 2020, just before the lockdown started.
Yeah.
And I remember sitting in Heathrow and I was reading on my iPad the stories about what this virus was and what was going to happen. And as I'm sure you remember in those days, you would see some scary videos from Italy of how people in hazmat suits trying to go to the supermarket. And I was just thinking this could be the end of the world. And other guys saying it's way overblown, this is never going to go anywhere. And we were in that period where didn't know where this pandemic was going to go. We hadn't experienced this for over 100 years. We didn't know anything. The data was mixed. The Fed had started to cut rates. Remember, they had raised rates in 18, 19, started to cut rates, and interest rates had been low for a very long period before then. Central banks were getting a bit concerned about growth, but everything looked okay. We were reasonably risk on in our positioning. And we said, what do we do now, guys? Do we start reducing risk? Started doing the scenario analysis. Scenario analysis was so tricky because you just didn't know what was going to happen. And again, where was the asymmetric skew? If things went wrong, we knew there was a fortune of downside. And if things didn't spread that badly, the markets had already done quite well and there wasn't potentially huge upside. So we started to reduce the risk quite a lot. And that paid off in the down cycle. Unfortunately, what we didn't do is re-risk enough going in. Because again, we struggled with the data and we saw the stimulus coming, we didn't know what was going to happen with the stimulus. We didn't think, especially in the US, they would spend all that money basically. We thought there'd be a balance between the Europeans seemed to save most of it and the Americans seemed to spend all of it and more. We didn't think the spending would be that high, and that was to our detriment coming out of the lockdowns.
What is the biggest misconception people have about multi-asset investing? Is there any thing that you want to dispel and let them know, listen, that's a misconception?
Yeah, it's an interesting question in that over the years, I've had people say to me, I suppose the one that always comes to mind is people say, sure, you sit at your desk all day and you watch share prices. It must be easy to generate alpha. Like, why don't you generate consistent alpha all the time? All you do all day, and it's especially people who are out of the industry, my optometrist or my GP, who like to speculate on the side, they'll say, but surely, I'm working all day and I'm speculating at night. Surely if you're doing this 10 hours a day, it must be easy. And I'm thinking to myself, well, the obvious example is day traders. And we know the success rate of day traders is exceptionally small for this exact reason. Often watching the markets too closely is to a detriment of your long-term process. Why we say it's always important to have a process you trust and you can fall back on, because watching the market all day is not going to help you generate alpha as much as people like to think it's going to. And I think people think you watch it all day and you take big swings to try to generate that alpha. It's certainly never been my approach or our team's approach or House's approach. And I think it's to dispel the myth that that's what we're trying to do is hit it out the park. We don't think that's the way you generate the right returns for clients in the long run. If the client's objective is to generate a return that exceeds inflation by enough linked to their risk tolerance, that's what we're trying to do, importantly, over full cycles. The best example is Warren Buffett. Now, I used to love the Warren Buffett books before I got into the industry. They're always interesting to read, and his track record is unbelievable. But what I realized being in the industry and active management is definitely his edge is time horizon. How many clients can I say to you, I want to buy Coca-Cola because I know it's going to be a winner over 50 years? It might be true, but if Coca-Cola has 5 years of bad performance or even 1 year of bad performance, it's going to be a discussion with the client. That's kind of the difference. If you have clients that buy into the multi-decade approach of investing through cycles, which we hope most people at a strategic level think that way, that's the kind of conversations you want to have. And then they understand that tactically you're trying to move around that in between the kind of long-term strategic cycles. So I think that's the myth, is that people think we're day trading all the time and looking at short-term movements and trying to generate all this alpha all the time on very short-term moves. Investing doesn't really work that way. And as I say, the example of day trade is trying to do that, whether you use technical analysis or quants or whatever you're using, often doesn't result in the best medium to long-term outcome. And the stats show you that. If it was so easy to watch stocks all day and generate alpha, I can assure you I wouldn't be at a corporate. I would be on a beach enjoying the mojitos.
Yeah, me too.
Yeah.
But Warren, you have that disconnect where clients are thinking or not thinking about long-term investing. The minute something falls, they're all over you like a rash. But how do you bridge that gap? Because to me, it's an education thing. And so how do you convince clients, listen, this is about long-term investing?
It's always an ongoing education process. It sounds like an arrogant thing to say, but it's not. In that the example I gave you earlier of the client mandate only becomes true in times of underperformance or crisis. When the client says, oh, no, I knew what was written in the mandate, I remember it, even though it was 5 or 10 years ago, but it's not what I meant. The key is always in between those two things. And as you say, that's the difficulty with clients. The only way we found, or certainly that I found it works, is you show them the longer term performance. You show them how cycles work, what happens with equity cycles over long periods of time. I can show you the example of Japan or Europe, where in local currency terms, they've struggled to get above highs of 10, 20, 30 years ago. So you can have those periods of equities that don't generate returns over multi-decades. And you can have periods like we've seen now in the US for the last couple of decades, where it's basically been a bull market for most of that period. These times are unusual. People think you get 20, 25% returns every 12 months and I'll just continue forever. Or the great example in South Africa, property has given you 52%. Oh, we'll get another 52 for the next 12 months. Well, you might, but know the risk you're taking once things have given you good returns. And cycles, the nature of them changes certainly. but you always have bull and bear cycles. You have secular cycles and you have cyclical cycles within the big secular cycle. And the only way I think you get buy-in from clients is to show them that over time. And it's an ongoing education, ongoing in the report backs every quarter that we have with institutional clients on our roadshow for retail clients, is show them how we're thinking about that and how to adjust portfolio construction as you live through those cycles. And again, as the world evolves and as monetary and fiscal policy evolves, you've got to evolve with it. Otherwise, you're going to be clearly left behind.
I want to cut to a question from the audience because this is quite topical.
Mm.
So I'd like us to kill that elephant in the room.
Sure.
How do US elections affect markets, US and global? And if so, how are you positioning for the upcoming?
Usually the answer is, and there was a great example recently from a political analyst, and now they call them geopolitical analysts because geopolitics has become as important as politics. He said what he tells his clients is politics is noise, and in the short term, it has no impact on markets, but in the long term, it determines everything. And I thought that was a very interesting insight from him, from the perspective of, I think it's right, the noise in the short term increases volatility at different times, and it can move things quite a lot, as we see now with the headlines. We saw the attempted assassination of Trump, not just once, twice, which, as I said to you before we came on, it seemed to be news for literally for a few hours and then disappeared. Volatility in the markets seemed to be for a few days and then disappeared. So I think that's a good answer. It's important for volatility of markets in the short term. Long term, it is critical, the same as geopolitics. And the current election is a great example. Why it's important is when the policies are vastly different. So you'll see Kamala Harris talking about tax. She's talking about raising tax on corporates in the US from around 21% to 28%. Trump wants to take it from 21% down to 15%. Now, I can assure you, if US corporate tax is either 15% or 28%, that's going to have a material difference on earnings going forward. Can they change the tax rates to that, though? And this is the question. It depends what happens in the election. Are they going to control both houses of Congress? If they are, it's much easier to change the tax. If they don't, and there's a split Congress like we've had for many years now, it's going to be much harder to change that tax. So even though the rhetoric's loud, it's highly dependent on the election outcome. And like the South African election, but especially this American election one, it's hard to know what the outcome is, purely because we know not to trust polls anymore. There's many issues with the polls. You've seen a change, obviously, from Biden to Harris now in the Democratic Party. She's new to the political scene at that level. It's hard to know what her policies will be once she's in power. The same as thing we learned from Trump. A lot of it is rhetoric. When he actually got in power, a lot more of it was toned down. So this is the critical part, is it's going to depend on the election outcome. It's not a great answer because you want something more definite. But again, it's about evolving with as it happens. And I can tell you, in November's the election, hopefully the results come out soon after the election. That's also debated depending on what the outcome is going to be, how long it's going to take to come out officially, is then the market will start pricing in what the policies they've said. But again, depending on whether they get a clean sweep of both houses or not, will also determine how different the outcomes are. So we're doing a lot of work at the moment on exactly that. The different outcomes, is it a clean sweep for one party? Is it a divided house and one of the parties wins? And what are the different outcomes, both from a regulatory perspective, how that impacts things like tax, things like the tariffs, and what impact that will have on various asset classes going forward. You've got to do this sort of scenarios again, so that when it happens, you're not, oh, this happened, let's do the scenario work. You've got to do it long before. And then when it happens, you've got the blueprint of how you're going to move forward with asset allocation.
Have there been any heroes or mentors that have shaped the way you think about portfolio management? What advice has stuck with you over the last 2 decades?
Yeah, as I say, I was definitely a Buffett acolyte in the early days. Maybe it's because we share the first name.
Only that.
And the letter of the surname, Warren B. But it's certainly, I fell in love with the idea of reading his mentor, Benjamin Graham's book of security analysis. You know, maybe it's my accounting background and I love spreadsheets, just doing all the work about a company. And I learned about modeling companies as an analyst. There is so much appeal to it. Learn a lot about a company, what drives the company's profits and cash flows, come up with a valuation, and as long as there's a margin of safety, buy it and put it in the drawer, and in the long run, you'll win. And what I learned from various people over my career and doing this myself is that be very careful with that thought process, for the simple reason that a valuation model, I learned, unfortunately, with time, can give you any answer you want. So often what I would do, it was a nice thing being on the buy side, you could get all the sell side models. And these are top analysts in the market, unbelievably smart people, hardworking people, know these companies backwards. You know, I could pick up an Anglo's model. This guy's covered Anglo's for 30 years, and I've been covering it for 6 months. Unbelievable insight into the company. Open a second rated analyst, top rated analyst, look at their models. They'll have exactly the same input because they're getting it from companies for mines, let's say. The volume in the mine, the costs of the mine, and then you would get to commodity prices and currency. And what you would see is they could be vastly different because of their view on commodities and currencies, or in fact, they could be identical. And then you would look through the model and say, but why are their valuations so different? One guy's got $200, the other one's got 150. How can they be so different? All the inputs in the model in these very detailed models are almost identical. And what you realize is their cost of capital view is slightly different. Okay. So one guy's view on the future cost of capital is much higher than the others, and therefore his valuation's lower. And that insight was, it's not about the amount of detail in the model. It's much more understanding kind of what drives the company's cash flows and ultimately be aware of the biases. I'd say the biggest lesson I learned was speaking to the analysts. You could see in this guy, even though he's been covering a company for over a decade, is he had a bias. Something's happened with management, something's happened with the company. He's either permanently almost bullish or bearish that company, no matter what happens. And that insight was important to learn early on, is that, you know, you can come up with almost anything. The other example that a colleague of mine, I think it was Sean Stockett in the old days, showed me about articles that you read in the newspaper or magazines. We used to religiously read the Business Day and Business Report and Financial Mail every week. And I was reading this article once about uranium, and he saw me shaking my head and saying, you know, I just can't believe what this person's writing, because I'd just been doing months of research on the uranium industry, and I knew the inaccuracies in this article. And he said, okay, so you see that now because you did the research before reading the article. Why do you trust the other 20 articles you're going to read in that magazine? And the penny dropped. He was exactly right. Unless you're an expert and done your own research on a subject, you shouldn't just be blindly trusting what you read. And now is a much more extreme example in today's society, because there's so much social media, there's a lot of opinions out there. And I learned that lesson, that most things, even from experts, tend to be an opinion. Learn what that person's bias is. That's why I say in our own team, it's important to know what each of our biases are, so that when people hear someone in the team talking, they know what bias it's coming with. And that confirmation bias, which is, there's many biases in the world. Confirmation bias is the one that I've learned, because there's so much data in the world. You can always find something in that data. You can always mine enough data to confirm what you're thinking, and always gravitate towards the people that sound smarter than you and think like you and confirm what you're thinking. It's very dangerous. The other example that my current franchise head, Marius, also likes to talk about is perma bears have no shares, and they'll always be bearish. And when a market correction happens, I'll say, I told you so. They didn't tell you that they've been bearish for the full 10 years of the bull market and missed the whole thing. They'll only tell you in the last year that it corrects. And that was, again, an important lesson to learn, is be sure you know where people are coming from. They can all bring up enough data to tell you the story they want to tell you. And that's something to just always be conscious of when you're going through any investment kind of research that you're doing.
Last question, Warren. If you could be anything else but a portfolio manager, what would you have chosen?
I'll give you a double answer, because it's not a simple one. When I was a child, funnily enough, I remember this because it's in my password. There are also security questions about childhood heroes and that. I wanted to be a postman. I've got this Postman Pat, for those of you old enough will remember that tune of the Postman Pat cartoons
Would
in
you
my
like to
head.
sing it for us?
No, no, definitely not. But the one where he had his black and white cat, those of you will know the lyrics. And I always thought, just this guy looks so happy. He's doing things for people all day. He's bouncing around. He's got his pet with him. It just looked like a wonderful career. But more seriously, as I got older and realized how hard it would be to be a postman, and in today's times it's almost disappeared, is it would have definitely been a professional footballer. Football is my passion. I still play it today at 48. It's getting harder. The injuries are a lot more. But actually, when I was coming out of school, I was training with Kaizer Chiefs Juniors, the under 17 team, and I had to decide whether I was going to concentrate full time on studies and work, or if I was going to try the professional sports route. Not something I necessarily regret. It was very different in those days. You couldn't see earning a living doing a professional sport like football. Certainly you can today, and I'm hoping one of my teenage boys will go in that direction. But in my day, it was a much harder thing to do. And through debate with my parents, etc., I decided to go on the professional route, give up football, but still play socially, which I've enjoyed ever since. So glad was my career choice. By luck, got into into a career where it is forever changing and will be forever changing. Now we've just got to decide whether AI is going to take all our jobs in this industry or not, and that's a debate for another day.
Warren, thank you so much for your time. Your whatever you've shared to us has been extremely insightful. I really want to thank you for that. Thanks everybody for joining us today.
Innate is a registered trademark of STANLIB Wealth Management Pty Limited, an authorised financial services provider.